Welcome to Charts That Matter. Today, I'm going to compare hard and soft economic data to understand the current state of the economy. There is a growing disconnect in economic data as hard data has been solid while soft data has been weaker. Let's dive in. First, I'm going to define our terms. Hard economic data includes objective measures like GDP growth, inflation rates, and unemployment figures. I also like to consider more real-time hard data such as TSA screenings, restaurant bookings, and hotel occupancy. Soft economic data, on the other hand, encompasses subjective measures such as consumer confidence and business sentiment. Let's start with hard economic data. Global GDP growth projections have been revised down for 2025, mainly due to the uncertainty around inflation. This chart shows the trend over the past few years. Let's not lose sight of the fact that GDP growth is still positive. And remember, a recession is often linked to 2 consecutive quarters of negative GDP growth. Next up is inflation. CPI is a commonly cited measure of inflation. It uses a basket of goods and services to track price changes for consumers. In order to measure the underlying trend in inflation, rather than temporary shocks to food and energy, economists often focus on core CPI. There are signs that inflation has stabilized, but it could take longer to achieve the Fed's target. In the US, the unemployment rate remains steady at 4.5%. This chart illustrates unemployment trend over the last year. Despite the large number of unemployed workers, businesses are still having trouble hiring. This could be due to a mismatch in skills, geographies, and high unemployment benefits. What are real-time activity metrics telling us? Thus far, they have been resilient. Air traffic, measured by TSA screenings, is flat year over year. Restaurant bookings are up 5% year over year, and hotel occupancy is above historical averages for this time of the year. While GDP growth may be set to slow, the resilience of these metrics would suggest the US economy should avoid a recession. Now, let's look at soft economic data. Consumer sentiment is an important indicator. Consumers tend to do well when the economy and markets are doing well, and vice versa. The preliminary Consumer Sentiment Index published by the University of Michigan surveys of consumers sank to 50.8 in April compared to a reading of 57 in March. Next is the Consumer Confidence Index published by the Conference Board, which fell to 86 in April, with the 2 components of the index declining. The Present Situation Index, which is based on consumers' assessment of current business and labor market conditions, declined by 0.9 points to 133.5, while the Expectations Index, which is based on consumers' short-term outlook for income, business, and labor market conditions, fell by 12.5 points to 54. According to the report, this is the lowest reading for this index since October 2011. Investor sentiment has also cratered, swinging wildly on a weekly basis over the past few years. Sentiment is often a contrarian indicator since stock market bubbles are often characterized by irrational exuberance. Hard data provides a factual snapshot of economic performance, showing mixed signals with steady growth but persistent inflation. Soft data reflects public sentiment and expectations, highlighting widespread pessimism and uncertainty about future economic condition. Both types of data are essential for a comprehensive understanding of the economic landscape. Hard data offers concrete metrics, while soft data provides insights into the mood and expectation of consumers and businesses. Thanks for watching, and stay tuned for more updates.